Yeah, I could hear you now. How are you?
Yeah, I'm good. How are you?
I'm doing fantastic. Okay, give us a breakdown. What is happening in the Sydney, Australia markets?
Well, Sydney's going down really quickly now. All the clearance rates have dropped. We're getting like 40% clearance rates, which, from a year ago it was like 65%. So there's another third that are not clearing basically, and there's a build up of stock now occurring. So I think it's the highest in like 8 or 9 years that we've got in terms of housing stock on the market, and the average days on the market is starting to go up. It's now about 3 months before places are selling.
Yeah,
It
3 months.
used to be
Well, 3 months
it
is
used to be
creating a
20
glut.
days.
It's creating a huge glut in the market because they're not moving as fast as they were, and more people throwing more supply. They're adding more supply onto the market, so there's an oversupply right now.
Yeah. Well, the other thing is that the construction completions haven't peaked yet.
I
So
know,
we
I know. You like 2020, 2021, 2022.
got another two to 3 years before construction completions peak. So the building starts peaked back in like 2016, and then there was another jump back in 2017 in like April, and then ever since then it's trended down. So it's usually about 5 to 7 years because the construction, they're big projects that all of these places are being built on. Like they're massive, massive projects. If you go down like a train line, for example, it's just apartments that are like 7, 10, 15 stories high. Um,
It's a concrete
and
jungle. Concrete
yeah,
jungle.
we got places like Mascot, Wye Creek, Ryde,
Hmm.
Epping, Chatswood, and they just have like apartments as far as the eye can see, but they're all still going up now, and people can't sell. Or people, it's more the biggest problem is people can't get a loan rather than people can't buy necessarily. Like there's an article that came out today in the AFR where they were saying people that use short-term debt contracts with things like Afterpay and ZipPay, which is it's like kind of like payday loans, but not exactly. It's just consumer finance.
Hmm.
So those people that use those products are starting to be rejected for mortgages because the lender is seeing them as not creditworthy, even if they've got a large deposit.
I saw the article you sent me about that lady that was using Netflix and stuff like that, and she got declined for a mortgage.
Like she had a 30% deposit for a place in Darlinghurst. Like Darlinghurst is one of the most expensive markets in Sydney, and she had 30% cash ready to go, and they still rejected her. Like
Mhm.
that kind of gives you an indication as to how hard it is to get a loan at the moment.
Yeah.
Like that's what it is. It's not.
I don't know why Skype is. I don't know. Are you there, Andrew?
Yeah.
Okay, sorry about that. I don't know why Skype is on my computer on. I don't even know how to do that. I don't even have it logged on, Andrew. I got Skype
Yeah.
on my phone, but I don't even have it on my computer.
It's weird, huh?
Yeah. It must have
You
uploaded.
should be.
Huh?
Yeah. I'm not sure, but anyway. Yeah. So everyone, as Kevin was saying, everyone in Australia normally says, "Oh, the spring market is always when it takes off,"
Mm-hmm.
but that's not the case. We're getting the lowest transaction volumes of the year at the moment. So
Well, what happened to the spring market is here in Sydney, and it's gonna everything's gonna go on an uptick. It's so busy in Sydney, and Sydney's gonna be so good in the spring. Prices will
yeah.
rebound, and what happened? Nothing.
Well, there's a guy on Twitter. If your followers want to follow him, he's called Shane Oliver. So he's the lead economist of AMP, and he posts like a weekly update of where the clearance rates sit,
Mm-hmm.
which is which is really useful because you can kind of have a look back and see what they have been and what they are now.
Mm-hmm.
Because the big thing as well is that they'll say the clearance rate is like 40, 41%, and then 20 20-25% of the auctions will go unreported, so you won't know whether it is actually 40% or whether it's like 35%. So they could be skewing figures up. Like, if they're not reporting it, it's almost always the case that the things they don't report haven't sold. And then the other thing that's really interesting is the concentration of how many places are declaring what they sold for as well, because there's no legal requirement in Australia for you to say what the price was that it sold at.
You know what's scary about that? I covered that a few weeks ago, but there should be some sort of a census on that, so people pulling land title records in the next in the future, or people, not only that, looking for even doing basic comparables on houses to see what a neighbor sold for, so you know if you're not getting ripped off. It's a zoo. It's a housing zoo market. Once it's a housing zoo market, you're into a lot of troubles, because then you don't know if you're tricking or treating.
Well, people are trying to hide loss-making sales. Like, it turns up, people eventually find out that they've sold at a loss, that they've sold lower than listing price. There's a very, very, very small pocket of the market where you can still sell, but it's off-market sales, and they'll have a reserve price, and they generally sell. But this is like, $50-60 million houses. It's not exactly run-of-the-mill houses that are doing that. You can't even with a $5 million house, you wouldn't be able to extend credit to someone like that. Like, people are just being rejected left, right, and center for loans. Like, my sister is pretty senior at one of the big four banks, and I actually had a conversation with her today about whether they see any risks on their book, and they still seem really sanguine about it. Like, they don't seem to understand how much risk they're sitting on. Like, I think they do it to an extent, but they can be one of the slower movers. And I'm not going to say which one it is, because, And the other thing that's really difficult to figure out is there's a thing called ADIs in Australia, which is an authorised deposit taking institution, which is basically a bank or a credit lender or a building institution or whatever, but they have the government guarantee, or what's called the financial claim scheme. And they have a guarantee on deposits, which a lot of these other lenders, like your Pepper Money, your Liberty Financial, and all the like private equity firms that have started coming into the market and trying to securitize all these mortgages. So that's started kicking off pretty recently. I think it was like late 2016 that kind of started taking off.
Okay, but what, Andrew? One thing that's concerning me about Australia is they're not raising interest rates, and they refuse to raise interest rates. And I understand you can't, but would this cause a ripple effect would it start changing the currency value? Your currency might take a little bit of a hit. I mean, isn't it normal for interest rates to go up to adjust to a seasoned market?
Yeah, but it's a question of where you get your money from. So there's a difference between interest rates. There's a difference between interest rates that you get, so the effective rate on your mortgage, and the interest that the Reserve Bank is setting. So the benchmark rate. So there'll be a premium on it, which is like the coupon rate that the banks make you pay. When banks issue a mortgage, they'll issue it at or like near the comparison rate, depending on how close you are to whatever metric they've set for that particular mortgage product that they're going to issue you. It's about a third to 40% of all of the mortgage, all of the credit that comes into Australia comes from US banks.
Right.
So every time the US yields go up, every time our bank bill swap rate rises, then there's added pressure on the banks to raise their rate. Right. So it doesn't matter what the Reserve Bank is setting the rate at, because such a large portion of our credit is coming from overseas. Like, it's the same sort of thing with like Spain and Ireland before the GFC. They were getting massive influxes of credit from France and Germany, because there was an arbitrage opportunity to lend into a market with higher inflation and higher interest rates, but they still had the same currency. So there was this massive currency arbitrage that you could just do by lending into a different market. Like if they lent in Germany, they wouldn't get the same return as what they would get by lending a mortgage in Spain.
Right.
Yeah.
Right. Okay, so where do you see housing in Q1 of 2019?
I think Q1 will probably lose another 4 or 5% in Sydney. It's going down about 1.5% a month, but it's accelerating. The downside is accelerating. So, and there's another thing that's really interesting is the historical refinance activity. So if you go through the bank's historical refinances, they usually occur at the end of January because all of the credit spend occurs in December.
Right.
Like the Christmas period and for New Year's, and we also have the Australia Day holiday, which is 26th of January, and then by the end of January, people go back to work and people go back to school and things like that. So there's there has to be like a scrimping to make sure that they can go back to their day-to-day lives. So a lot of refinance activity occurs when people come back from their holidays at the end of January.
Okay, let me ask you another one. What do you think is so what do you think, how do you think, or I know you've been following this, the Royal Commission is really, I guess, putting the nails to a lot of these bank managers and bank CEOs.
It hasn't surfaced.
What's that?
It hasn't really to surface. It hasn't really done that much.
Well, but some of the stuff they're bringing up and they're finding, like so far, it's just phenomenal. Charging people bank fees that have been dead for 20 years instead of contacting their next of kin to say, hey, your husband has this in an account. Does your family want it? I see you're falling behind on your mortgage. No, they're charging what? One guy was with $2,300 a year in bank fees, and he's been dead for so many years. Like, what the heck is going on? What do you see happening with the Royal Commission? Do you see them uncovering even more dirt?
Well, the Royal Commission's finished. All they've got left from the Royal Commission is the recommendations that come into. They're going to put them out in February next year. So they haven't really uncovered that much, like, compared to what I know is going on.
Right.
So, like, they've done a little bit, but it's not the whole story. Like, the stuff that they have uncovered is pretty damning, but I would say they probably looked at about 25 to 30% of the whole picture.
Okay, I see where you're going. I understand. I guess they don't want everyone to know everything, because if people knew everything, I think it'd be pretty big.
But if you look at the actual terms of reference of the Royal Commission, the main focus of it was occurrences that fell below community standards.
Right.
And the biggest issue of everything is the fact that all of the examples that the Royal Commission went through were bank submissions or industry submissions. They weren't from the regulator, and they weren't from there were very few customer complaints. It was primarily banks that submitted the information to the Royal Commission. So they were picking and choosing the things that they would admit to.
Okay.
Right? So that's why they haven't gone to the full extent of what the actual problems are. Like they skimmed over how HEM was being used, the household expenditure measure was being used to quantify the serviceability of loans. And the banks admitted that 3/4 of the loans they issued were based on this index benchmark. But the problem is, I think it's like 80% of the population spends above the index benchmark, but they were qualifying 3/4 of the loans. So it's like, for all intents and purposes, it's basically like not doing income verification when you give out the loan. And that's not like a quarter of the market like it was in the US. Like they say, oh, we're really well regulated in Australia. But if you're doing loan qualification, but you're not doing it in such a way that actually captures realistic information, you're not really doing income verification. Because if someone's income's like 100K a year, and you say their expenditure is 30K, but it's actually 70K, then their net income is 30K as opposed to being 70K. So you've just put their income up by 133%. So,
Yeah. I know. I've read about
Yeah.
that. Yeah, I've been reading about that. That's so much fraud. It's like, who do you blame? Do you blame the customer for lying? Do you blame the lender for not doing a background check? Do you
I
blame?
don't. I don't think it's mostly on the customer side. I think it's about 40% customers and 60% banks.
Right. Well,
Really?
because in the end,
Well,
it's the bank that's lending out the money, so it's their money. They got to protect their ground, right?
Well, there's three laws that the banks have to follow. There's a massive law called the National Consumer Credit Protection Act,
Mm-hmm.
which they're supposed to be following, but they don't. There's also RG 209, which was
Well,
came out.
if they that first one you mentioned, well, the first one you mentioned, if they went by those guidelines right off the bat, they probably lose half their deals right there.
But the extent of it is like massive, even beyond that. Like if you start looking at loans that have been issued with less than a 20% deposit, you have a thing called lender's mortgage insurance, which you're supposed to pay.
Right. It's like
Right.
HS. It's like HSBs or H.
Lamar.
Yeah, we have it here in Canada too.
Yeah, it's the same sort of thing. But the problem is, because of the way that the terms and conditions have been written on the lender's mortgage insurance from places like QBE and Genworth, the banks have decided to start doing it with their own loans. So they don't go through external companies. They're self-insuring their mortgages through LMI. It's not called LMI on the loan application form anymore.
Mm-hmm.
It's called a risk fee.
Mm-hmm.
So you're not actually paying for insurance against your own loan. So the bank is taking on all the risk for, regardless of what your deposit size is. So they're definitely going to try and claw back some of the debt. So if there's places that start going under, most of the equity that's going into them that have got 5 and 10% deposits is come from home equity from their parents. And a lot of the people with deposits that size are generally first home buyers.
Mm-hmm.
So you're going to start seeing not just first home buyers start default, but it'll be the parents that lose their house as well.
Yeah. So,
So
it's the
it might
domino
be
effect. It's
fine,
yeah.
but all of a sudden 10-15% because of all the people that have put in home equity.
Yeah, I know. I see where you're coming with this. I read an article about that about a year ago, where parents were using their equity in their homes to buy their children homes. And then, what about that article I read? It was about 8 months ago, where parents in Sydney were buying 7-year-olds houses and condos.
Yeah,
That's
it's speculative mania. Like if you're getting to the point where you think you have to buy 2 generations ahead, that it's not realistic. Like you're in mania at that point. Like
Well-
there's obviously going to be recession cycles. Like if the child's 7, what happens by the time they get to 30? You think there's going to be another 27 years without a recession? Like
yeah,
we're already on record for the longest period of time without a recession. And
right,
that's not a record you want, because as soon as you do have a recession, it's that much worse.
right. Well, yeah, of course, because it's gonna go through that natural cycle, right?
Yeah.
So, okay, one last. Let me ask one more thing. What was I gonna ask? What was it? Oh my god, I totally blanked. I had it in the back of my mind. I wanted to ask you. So, you know what? I forgot what it was. It was about. We already covered the Royal Commission. We already covered.
Was it anything we were talking about earlier today, or
No, I completely slipped my mind. If I remember during the show, I'll message you. I'll say it in the live, and you could. It was Okay, we already talked about Q1 2019. We already talked about. Pretty much covered. Yeah. Oh, yeah, I got it. Interest-only mortgages coming up to fruition next year. A good percentage of them, about 22% to 30%, are going to come up to fruition in this.
it's more than that. 40% of all loans issued by the end of 2014 were interest only, and the interest only period is 5 years. So by the end of next year, you're going to see 40% of the loans of that vintage that have to be refinanced. But if it comes to the state where less stamp duty or less the transaction costs of buying the property, they end up being break even or in negative equity, not only will the banks not refinance them, they'll be in negative equity because they've lost a percentage off their house to the point where their deposit is lower the amount of money they have left in the house is lower than the deposit than they put in. Like, unless they're paying, because if they're paying interest only, the only equity they have in the house is the deposit plus whatever the price goes up.
Right, which it hasn't been.
Yeah, which it hasn't been. So if we start going back to 2014, 2015 prices by the end of next year, which I think we will be, because say it's 25% reduction by the end of next year, or 20 to 25% by the end of next year, a lot of these people are going to be in negative equity.
Well, for sure, but here's the problem. If they could be maybe okay if they didn't touch their line of credit, if they didn't touch their credit cards, if they don't have a car payment. So if they didn't like borrow against the house,
got nothing left. The savings rate's negative at the moment. We don't have any savings to go against to do that.
Right.
We already have the second highest household debt to GDP in the world behind Switzerland, and we're the highest household debt to GDP country in the world. If you look at countries with a balance of payment deficit. So we don't have any money coming in, but we actually, in fact, we have money going out of the country, and we're also really high in debt. Like, there's no way to offset the household debt that we have. Like, we can't export things to make money to try and offset how much debt we have in the public in terms of the population, not the government.
Yeah, right. Okay, well, thank you, Andrew, so much for calling in and giving us a Sydney, Australia-wide update. I appreciate you taking the time to do that. And, yeah, maybe we'll do a market watch maybe next week, sometime during the week. Let me know when you're free. We could do a market watch update and maybe going over the world markets and what's going on.
All right, that's good.
Thank you so much, my brother. Enjoy the rest of your night.
Will do.
Okay, bye.